Hello, fellow Rebel Capitals. Hope you're well. So the jobs markets, the jobs numbers shocked the markets. My goodness gracious. Did you see that? What the number actually was today for the establishment survey and what happened to the unemployment rate. I mean, this is huge news. And more importantly, how did this impact asset prices such as gold, the dollar, which made big moves today for sure, especially the dollar. And then we've got to talk about inflation expectations soaring. And what does this mean about 2025? And have we seen the expectations for inflation soar like this in the past, or is this completely unprecedented? We're going to discuss that right now. Let's get into the first story of the day, and that is the jobs numbers. My goodness gracious. Go right over to Zero Hedge. And the expectation, I believe, was for about 165,000. And it just smashed through that level. And it was 256 for December. So, title of this article, Scorching Hot December Jobs. U.S. unexpectedly adds massive 256,000 in December as unemployment rate drops. It went down from 4.2 to 4.1. Still triggering the SOM rule, but we're seeing a little noise there. I mean, for me, I've got to ask, and I constantly ask myself the question, is the base case about the recession wrong? Or what would need to happen in order for me to change my mind? And we talk about that frequently as far as what's happening with interest rates. Long end of the curve versus the short end of the curve, the bull steepener versus the bear steepener. I go over that all the time, so I'll skip it for this video and just go over the data. But for those of you who are in my camp, meaning that your base case is we do see this cycle play out like last cycles, as far as when we get that inversion. I mean, you got to ask yourself, what would make me change my mind? I mean, we've got to be objective about this. You can't get dogmatic. You can't have bias, at least if you're trying to manage a portfolio, including your own. All right, let's get back to it here. With consensus expecting 165, and there was a whisper of it being around 187, we got 256, nearly 100,000 higher, or a 4 sigma beat, according to Zero Hedge. The change in non-farm payroll, excuse me, did I say establishment survey? I believe that is one and the same. Josh, can you look that up for me real quick? The non-farm payrolls, I believe, I should know that right off the top of my head. Been a long day today, guys. I went to a gold mine in the middle of Colombia and drove back, so you have to bear with me. But Josh, look that up real quick, please. Change in total non-farm payroll for October was revised up from 7,000 from a plus 36 to a plus 43,000. But the change for November was revised down by 15,000. Okay. With these revisions, employment in October, November combined is 8,000 lower than previously reported. We're still, I mean, we're seeing blowout numbers, but we're getting them revised down as we have basically for the last 2 years. But even with the revisions down, those numbers are still pretty strong. You know, I've said that kind of how I time these things. To me, it's all about the unemployment data or the jobs numbers, and I would have to see that go negative. So, in other words, if I see that go negative, that's when I put the pedal to the metal as far as the trade around recession. Now, for me, that trade might be different than what it is for you. You may have your own way of playing that, but that's how I'm kind of timing it. You know, you can take all these data points that we discuss, but when or if I see the jobs numbers go steeply negative, that's when I know it's time to put on that trade. Okay, getting back to it here. So we're seeing a discrepancy like we have since pretty much the middle of 2022 between the establishment survey and the household survey. So yeah, okay. I think Josh, you can confirm there. But
establishment and non-farm payrolls are not the same.
Non-farm payrolls in the establishment survey?
They're not the same. They're closely related, though.
Okay. So the here we're looking at the establishment survey and the household survey. I'm gonna have to look into that a little further, Josh, because I know the household survey is what they use to calculate the unemployment rate. So anyway, let's keep going here. I don't want to get stuck on that because the bottom line is we've got a huge discrepancy that is continuing to grow larger and larger and larger. So if we are looking at the establishment survey, it's looking great. But if you're looking at the household survey, it's looking like recession. It's basically flatlined since 2022. So you got to ask yourself, who's right, who's wrong? So they talk about how this was a blowout number. Unemployment rate went down to 4.1 from 4.2. The underemployment rate went down to 7.5 from 7.8, a 6-month low. They said the only aspect that wasn't smoking hot was average hourly earnings, which at 0.3% month over month came in line and in fact missed fractionally, printing at 3.9 year over year, down from 4%. Yeah. I'd be very curious what total numbers, or excuse me, total hours worked. Let's read these bullet points here. Among the unemployed, the number of permanent job losers declined. Okay, so that's positive. In December, the number of long-term unemployed changed slightly. Labor force participation, unchanged. Number of people employed part-time for economic reasons at 4.4 million, little change. Number of people not in the workforce who currently want a job at 5.5 million, essentially unchanged. So overall, you've got pretty positive. Now, as you would expect, healthcare kind of leads the way, retail, trade, government. I mean, again, we get a number with 33,000 in government jobs, below the average gain of 59,000. Ugh. See, it's not totally juiced, but in my view, you've got to exclude the government jobs from this. I mean, what we're trying to do is look at the efficiency of the economy. And government jobs are a drag on the economy. So in my mind, we should have two separate numbers here. We should have one with government jobs and one without. By the way, just fun fact, when they measured the unemployment rate in the Great Depression in the 1930s, they actually did exclude government workers. Just quick FYI. I think far more appropriate. Here's a quote. December's job report was solid across the board. While we expected the strong showing in the establishment survey. Josh?
Did I fail?
I think you might have failed right here.
I don't know why the thing says they're slightly different.
Let's keep, let's keep going here. Anyway, let's keep going. December's jobs report was solid across the board while we expected the strong showing in the establishment survey. Maybe they came out, maybe all three of those come out at the same time, Josh. Maybe non-farm establishment survey and household survey come out. They all came out today. Maybe
it says that non-farm payroll is a subset of the establishment survey.
Yeah, so it's basically one and the same. Okay, that's what I thought. All right, I'm not going crazy. I shake off those cobwebs from the 6-hour drive today going to that gold mine. We're going to do a video on that. next week, guys. You want to stay tuned for that. It's really, really cool. Getting back to the topic at hand. We take that as an encouraging sign the job market may be stabilizing after deteriorating steadily over the second half of 2024. And that's what we talked about just yesterday on yesterday's video, according to the Challenger survey. The Fed will likely conclude the report supports their view economy is solid and can withstand a pause in rate cuts. That's why the market just tanked today. More on that in a moment. I'm talking about the S&P 500. So here we've got another quote from some global strategist, expert person. The Fed can be very comfortable staying put in January. Okay, basically, I think every single one of these quotes is going to be about the Fed now pausing, which, oh, actually, here's one from George, our good buddy, George Goncalves. So if you haven't seen any of my interviews with George, really, really sharp guy. He's an expert in the bond market. And let's read what he's saying. The only saving grace for the bond market at this point will be if risk markets really start to unravel, which is what we've kind of seen. Otherwise, there is no magic number that will be a line in the sand, especially with all the uncertainty ahead around fiscal and government policies, which may prove to be inflationary. More on that at the end of this video. Last topic of the day, guys. Inflation expectations soaring. Does that mean we're going to get a reacceleration of inflation in 2025? I'll give you my opinion in just a moment. All right. So let's go over to how this is impacting asset prices. That was the next topic of discussion. And I want to start off with the dollar because you guys know from watching my videos, I think the dollar and the long end of the curve is pretty much the most important metrics or data points that we need to consider when trying to come up with the probabilities or an analysis of what's going to happen, not just with global markets, but with asset prices in the United States or assets that might be in your portfolio, such as gold, Bitcoin, real estate, S&P 500, etc. All right, so let's shoot over to CNBC. And you can see gold actually up today, which really surprised me. Like we had the 10-year up 8 basis points. I mean, we're getting close to 4.8. That's a big deal. Why is that a big deal? Well, let's think about this. Let's just assume for a moment that inflation and growth expectations are increasing. Now, they're still not high, but they're increasing. Let's say that doesn't pan out. Well, then these higher interest rates become a self-fulfilling prophecy, don't they? Because if the economy isn't on fire, if we don't see those growth expectations or inflation expectations pan out, but yet we see interest rates on the 10-year going up and up and up and up, well, that's usually the straw that breaks the camel's back, right? Because if you don't have that economy that's humming along, if the economy is fundamentally unsound, then what happens when the 10-year goes up due to these inflation expectations that are offsides, that becomes that kind of self-fulfilling prophecy, if you will, where those rates bleed into things like mortgages. That makes housing more expensive. That means demand crashes. At some point, the prices start to come down. And then this impacts the unemployment rate. This impacts aggregate demand. Now you may be saying to yourself, oh, George, that's nonsense. That's never going to happen. Okay, well, it's exactly what happened in 2008. Exactly. Now, more on that in just a moment. But let's also look at the flip side of the coin. If George Gammon's base case is wrong, and I'm more than happy. In fact, I'd actually like to be wrong, because if I'm wrong, that means the economy in the United States is doing better and we might not have a recession. And why would that be bad? Right? I'd rather be wrong and have the economy do well for my fellow Americans than be right and go through a 2008 again. That's for sure. So you just have to ask yourself, again, going back to the theme of like the past 2 weeks in videos, perception versus Probabilities. The perception right now is that the economy is smoking. Now, based on what you think, what are the probabilities? Getting back to it. So we had bonds go way up, which you would expect to see gold go down. And you didn't. Again, you saw gold go up. I don't know. Maybe that has something to do with inflation, but people say that gold is an inflation hedge, and over decades it is. But from year to year, I don't really see a correlation with gold and the CPI. I mean, try to find one. And maybe in the 1970s a little bit, but after the 1970s, I mean, we still had consumer price inflation going up. Or we still had prices going up, excuse me. We had consumer price inflation coming down, so we had disinflation. But the price of gold just went from 800 roughly all the way down to, 200? And over the span of 20 years, from 1980 to 2000. And then you had gold really rip higher from 2000 to, 2011? But during that time, you didn't see a reacceleration of inflation. You had continued disinflation. So there's almost an inverse correlation there. And so maybe more recently, bottom line, it's just a coin toss. I mean, look at a chart. Don't take my word on it. Look at a chart of the CPI and the price of gold. But to be fair, over the span of 100 years or the span of 30 or 40 years, are you going to be able to buy as much stuff with that ounce of gold as you could, in the 1950s? Absolutely. Absolutely. So, people like to think that, if inflation is going up, then gold is going to go up immediately. It doesn't really work that way. And Bitcoin can be almost the inverse of inflation expectations. What's more so tied to inflation expectations in real time is going to be the bond market, more specifically the long end of the curve. But definitely a surprise here with gold. Also a surprise with Bitcoin, because as you see inflation expectations rise and as you see interest rates go up, since Bitcoin trades, you can tell me I'm crazy or whatever, but the bottom line is this is not my opinion. It's just, it is what it is. Bitcoin trades as a risk asset. So with rates going up by 8 basis points on the 10-year, you would expect risk assets to go down. But Bitcoin actually went up. So that's great news if you're a Bitcoiner, not just because the price went up, but because you see a decoupling with risk assets. And hopefully, in the near future, Bitcoin will actually become a non-correlated asset. Now let's get to the big action here, guys. And this is with the Dow down 700 points. And the NASDAQ down 317. Oddly, the exact same in percentage terms. Look at the Russell. So Dow and NASDAQ down 1.63%. The Russell down 2.22. Why is that? Because everyone was hoping that these lower interest rates would benefit all of those companies in the Russell that just burn money. I don't know what percentage of the Russell 2000 are non-profitable, but it's a huge percentage. So when they're going to roll over their debt, which they have to have just to survive, the idea is that if interest rates are going down, that's going to allow them to take a breather, a financial breather, so to speak, and that would benefit them. Therefore, their share price would go up because their debt they have to roll over, that they have to survive, is going to become less onerous. Now, of course, that omits the elephant in the room, which is if the rates are going down, inflation and growth expectations are going down, which would mean the economy is sucking hind tit, as my father used to say. So how is that going to benefit the Russell 2000? You see, it's a double-edged sword there. Be very, very careful what you wish for, because usually when you get low interest rates, you also get a crappy economy, which is going to, which is going to hurt those companies just as much as higher interest rates, or that is going to hurt them as far as the lack of their revenue because aggregate demand goes down. That's going to hurt them to even a greater degree than the benefit from interest rates going down to begin with when they roll over that debt. Again, we're talking about trade-offs here, guys. It's always about costs and benefits. Let's look at oil. Oil still climbing. So I think this is due to supply side constraints. I would be very surprised if this was demand side driven based on what we were talking about yesterday with China, Germany, Japan, pretty much the whole planet Earth, except for the United States. You know, you also have to factor that into your analysis, right? Currently, it seems like the United States, the economy is just jamming. It may continue. It may get even better. I sure hope it does. But what are the probabilities when every single other country is going into a recession, if not worse? I don't know. I mean, I'll let you be the judge, as I always say. But bottom line here with assets is Dow down, NASDAQ down, Russell down, S&P down, gold, crypto, oil up, long into the curve up as far as yields. But let's talk about this one, guys. This is by far the most important in my mind. And this is the DXY, the dollar, almost up to 110 right now. Why is this so important? Because it's all these countries like Japan. And now let's differentiate between the country, Japan, and all of the private sector businesses in Japan. So I'm focusing on the private sector businesses. They have a lot of dollar-denominated debt. A lot of their inputs are denominated in dollars. So, but most of their cash flow is denominated in what? In yen. So as the dollar goes higher and higher and higher, it becomes harder for them to make those monthly debt payments. And if they have to roll it over, then they're going to be rolling it over, and it's going to take more of their cash flow to do it. The longer the curve is going up, then that might impact their dollar funding costs, and that would be a huge negative. But on top of that, they get a double whammy in the sense that all those inputs, such commodities, are denominated in the dollar. Therefore, they need more yen just to buy that one barrel of oil, and they need more yen just to make that monthly payment that they've been making. And that's if the interest rate stays the same. If they roll it over and have a higher interest rate, then that's a triple whammy. So this is very, very negative for the global economy. And basically what we're doing here with the dollar is the global economy is basically a guy that you got in a fight with. You got him with a right hook. You knocked him out. And now when he's sitting there unconscious on the sidewalk, you're kicking him when he's down. And maybe he deserves it. I don't know. But that's basically what's happening here when you have the likes of Germany, China, Japan, Malaysia, India, Brazil. All these huge economies are going through these massive, massive problems, likely headed into an economic recession, contraction, while at the same time, the dollar is going up, just exacerbating the problem. And then the dollar most likely goes up even further. Why? Because you get into this feedback loop where in order to make those payments for the commodities that are denominated in dollars that we talked about earlier, or in order to make the payments on the dollar denominated debt, you got to sell an asset on your balance sheet. Well, if you're a Japanese mega corporation, what asset are you likely going to sell? Probably yen to buy the dollars that you need to buy the stuff, the inputs, or to make the payment, right? So then you have more supply of yen hitting the market. You have more demand for dollars, which makes the dollar go up even higher relative to the yen. And oh, by the way, let's say that you do make that payment. You get the dollars you need. You make the payment to the bank that you borrowed from to begin with. But what happens to those dollars? Do they just sit on the bank's balance sheet? No, because they weren't really dollars to begin with, just dollar-denominated credit. So the punchline is when the Japanese mega corporation makes that payment, the amount of dollars supply goes down, unless you've got more lending to offset the decline with the debt payment to begin with. So all of these things just lead to the dollar going higher against other fiat currencies. That's, one of the main reasons why I've been bullish on the dollar relative to other fiat currencies for the last, 3-4 years. It's because of the mechanics. And I always say that mechanics. And so many people say, "Oh, George, you're just getting way too far into the weeds. This is all just unnecessary nuance. You're splitting hairs." I'm always like, no. The devil's in the details, guys. The devil's in the details. All I need to know is that the Fed's money printer goes burr, and that means the dollar's going to go down. Okay, whatever. You go ahead and just have that belief. And if the dollar goes down relative to goods and services in the United States, great, you got it right. But that's not what we're trying to figure out. We're trying to figure out the dollar versus other currencies because that's so important for global liquidity. And at the end of the day, if we have global liquidity declining, what's most likely going to happen to the price of gold, Bitcoin, stocks, U.S. real estate? It's likely going to go down. What was the GFC all about? Was it about a mortgage crisis in the United States? No, absolutely not. If you would have had mortgage defaults on subprime, let's say, go from 3 to 6%, which is basically what happened. People think that the default rate on mortgages went to like 30 or 40%. No. It went from like 2 or 3 up to like 5 or 6. That's it. That would not have caused a global financial crisis. What did cause it is the way the system was set up to begin with, and this resulted in a liquidity crisis, a shortage of dollars, however you want to say it, right? And what did that do to all assets? It made the correlation go to 1, and they went down, including gold temporarily, but that was your buying opportunity. But that's why it's so important to really focus on the dollar versus other currencies, even if you are in the United States. I cannot overstate that. All right, now let's go ahead and move over to inflation expectations because they are soaring here, and consumer expectations. So we need to decipher how much of the psychology of inflation really goes into future prices. Because if you ask the Fed, that's what it's all about. That's where inflation, in other words, consumer prices going up, that's the main driver. That's where it comes from, is that people think that prices tomorrow are going to be higher than they are today. So they go out and buy everything they possibly can, and they just hoard everything. And that makes demand go up. And that just makes this, again, it's a feedback loop, right? It's like the wage price spiral. It's just because the expectations for inflation go up, it becomes a self-fulfilling prophecy. Now, this is total nonsense. Total nonsense. Because think about the stuff that you guys buy daily. It's most likely going to be energy, putting gas in your car. It's probably going to be food. It's probably going to be your health insurance, paying for your kids' schooling, maybe buying clothes for your kids. Maybe they're going back to school or they need some new tennis shoes or something like that. Out of all those things that you buy daily, how many of them would you not buy because you thought, or would you buy right now, even though you didn't need them, because you thought the prices were going to be higher? Or it's the exact same thing with deflation, right? How many of them would you not buy today because you thought prices were going to be lower in 6 months? You wouldn't do that. That never goes into your decision-making process. If you have to put gas in your car, inflation expectations don't go into that. You're not going to put more gas in your car today because you think that gas prices are going to be higher in 6 months. No, you're just going to fill it regardless, right? Are you going to not make your rent payment? Or are you going to make more rent payments because you think that prices are going to be higher in 6 months? Are you going to buy more food? I mean, come on. No, absolutely not. Now, the one thing that people do take into consideration as far as inflation or deflation when they're buying today, assets. Assets. In my view, in the real world, that is the only thing. So if you believe that housing prices are going to be lower in a year, then you might not buy today. Or if you think that housing prices are going to be higher in a year, then you'll probably buy today. But excluding assets, everything else, that whether you think we're going to have inflation or deflation really doesn't go into your decision-making process on a day-to-day basis. But the Federal Reserve and the 900 PhDs over there think that this is the main driver of inflation. So it goes back to what we say on this channel all the time. It's not really about what you think. It's about what the market thinks. And in this case, it's about what the Fed thinks. Now, is that going to bring inflation into reality? Whatever the Fed thinks? No, but that's going to go into their decision-making process when it comes to interest rates and the Fed funds rate, overnight rate, and what they do moving into 2025. And that's why we've got to pay a lot of attention to this. And that's, again, why we have to ask ourselves, regardless of what we think, what does the Fed think? Even though we know they're completely insane and their models are utter nonsense. So let's go over to this Bloomberg article. This is from today. And this is from the Michigan survey, the Michigan Consumer Survey. And we see U.S. consumer inflation expectations jump. But they didn't just jump. They jumped to the highest levels since 2008. I think you guys can see where I'm going with this. It's not to say that 2025 is going to play out exactly like 2008. What I am saying is it's possible. It's possible. Because a lot of people that don't study history would say, oh my gosh, unemployment rate going down. Oh my gosh, the long end of the curve going up. Oh my gosh, CPI being sticky. Oh my gosh, inflation expectations soaring. Because we have these 4 data points, or 5, whatever it is, therefore, the probability of us having a cycle like 2008 is very, very low, if not completely off the table. And that's where I step in and say, whoa, 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 time out. Not so fast, my friend. Because we have seen these things before. And we have seen how they played out. And they did not play out with inflation. They did not play out with the Fed pausing interest rates. They didn't play out with the longer of the curve continuing to go up and a reacceleration of consumer prices. See? So it's not a prediction. It's just pointing out that it's still a possibility. And just because we have these, let's say, conflicting data points, it doesn't take the recession completely off the table. But we still have to be objective, going back to what we said at the beginning. And I, George Gammon, have to sit there and say, hey, when will I be wrong? When will I have to change my base case? You got to be data dependent, as the Fed says. Okay, so let's go through this here. Long-term inflation views rose to 3.3 in Michigan survey. Preliminary January consumer sentiment index eased. So we've got consumer sentiment going down. It's lower than expectations, which is odd when we have a 256,000 job print, right? 2 other data points that don't really match up. If you look at the consumer sentiment, It seems like that's leaning more toward the household survey than the establishment survey. But getting back to it, this 3.3 month over month rise was an increase of 0.3 from 3% last month. And again, it is the highest level since 2008. And here they're doing a kind of side-by-side comparison of where we were in 2008. And it's eerily similar. Now, what I want to do is shoot over to long-term trends. And I want to show you guys exactly what I'm referring to. Because so many people on CNBC, so many quote-unquote experts just assume that because inflation is sticky or because we have inflation expectations increasing, that completely eliminates recession. That takes it off the table. But let's look at 2007, the last major cycle here. And right when they started cutting rates, I talk about this on the channel. This thing never wants to behave. I don't know why. It always wants to stay up there on money supply. I'm trying to get the red line. Aha, there we go. Unfortunately, this is August, but the concept is the same. I was trying to do September of 2007, but this thing's a little fickle. So we'll stick with August 2007. The CPI was at 2.76. Now, fast forward to July of 2008, and the CPI was lower. Most people would expect that it was. No, it was way higher, 5.6. 5.6. And that's why, I mean, we had this huge increase from, let's say, 2.63 all the way up to 5.6 within the span of 8-9 months. That's why, if you go back to 2008, especially the beginning, inflation expectations were sky high, just like we saw today. But then look what happened. We go from 5.6, and you guys know how this movie ends. Straight down to -2. And if you read the Wall Street journals from back then at 5.6, the middle of 2008, they're sitting there saying that the Fed is way off sides. They cut too much. They cut into a red hot economy. And now it's going to overheat. And we have to worry about inflation. In fact, going into the end of 2008, the Fed needs to hike rates. Forget pausing. They got to start a rate hiking cycle. This was the narrative in July of 2008. And oh, by the way, guess what the 10-year Treasury yield did from March to July of 2008? Let's actually pull that up. I think you'll find that interesting. Hopefully I've got that somewhere. I do not, but we can pull it up real quick here. Ten-year. That should pull it up. Okay, so we're going to go, we got this zoomed in, which is perfect. And then we're going to look at 2008, and we're going to go back to March. 3.34 is a 10-year Treasury yield. Let's fast forward to July, 4.27. So it goes up by, 90 basis points, call it. I think if you get the absolute low and the absolute high, it was right around 100 basis points that the 10-year Treasury went up during that cycle, while inflation expectations were soaring, while the CPI was going from, call it 3 to 5.6, while the mainstream narrative is that the Fed is cutting too much and the economy is going to overheat. This is right in the middle of when we were in a recession. In fact, right when we were in the middle of the global financial crisis, they were saying these things. And you guys, like I said, you know the story, right? Inflation tanked to a -2%. And within a month or two of them coming out in the Wall Street Journal and saying that the Fed has to hike rates, the Fed took rates from about 2% straight down to 0. And they started QE because we had the biggest financial disaster since the 1930s, which, oh, by the way, the bond market predicted to perfection. Let's get back to this Bloomberg article. Nearly 1/3 of consumers spontaneously mentioned tariffs. So this is why they're thinking that prices are going to go higher. I mean, it's got to be that, and the fact that they have PTSD from prices going up massively since 2020, and it's understandable. I mean, you guys know how much prices have gone up. Every single time I go back to the United States, I get sticker shock. It's like, you're charging me what for a turkey sandwich? You're charging me what for a toothbrush? This is insanity. So I totally get it. So I think that the recency bias there is what's leading most people to think that inflation is going to be much higher next year, around 3%. And then the tariffs are kind of just maybe icing on the cake. They say that the expectations are still lower than they were in the 1970s. This makes sense. Look, we're not going into the 1970s. We're not going into the 1970s. Why do I say that? Because the banks aren't playing ball. We're just not seeing the M2 money creation. You would have to see M2 going up very, very quickly in order to get a repeat of the 1970s. Now, we could have a repeat of the 1940s, but those were much different dynamics that increased inflation or consumer prices. And that's why we saw those huge spikes and then the big drop downs, where the 1970s was more, it was a roller coaster ride. Nothing goes up in a straight line, but it was more like this. And in order to have that sustained consumer price inflation and it going higher and higher and higher, even with bouts of disinflation, you've got to have the banks creating more currency units. There's got to be more currency units chasing goods and services. And it can't be just through the government, or the Fed doing QE, which increases M2. You've got to have the banking system playing ball, in my view. At least that's what history tells us. That's why I think the probability of the 1970s for the 2020s, very low, even though I think this will overall be an inflationary decade, meaning prices at the end, call it 2030, will still be much higher than 2020. But that doesn't mean that it's the 1970s. Much, much different there, the 1940s than the 1970s. To go through that year by year, even though the overall price increase from the start to the finish was similar. The university's index of overall consumer expectations fell to a 6-month low. See, this just doesn't jive with the jobs numbers. It doesn't jive with the establishment survey. More consistent with the household survey. Getting back here. So monthly low of 70.2, as half of the respondents said they expect unemployment rate to rise. All right. I mean, that's not a good sign. Not a good sign. But we've got to just add that data point into the rest that we have. And again, you're never going to have 100% bullish or 100% bearish. It's just you've got to just use this weighing machine and determine the probabilities based on if the data is skewing to the negative side or to the positive side on net balance. The month's decline was concentrated among Republicans and political independents. See, what that tells me is they were super, super excited about Trump last month. And then they kind of woke up and they're like, oh, actually, let's get back to reality. And the reality is the job market ain't so hot. And the reality is the underlying fundamentals of the economy stink. It's kind of like that honeymoon phase with Trump, and that kind of euphoria is declining rapidly. All right. I think that's going to do it. What I'd like to highlight for you guys, and I'm sure you're going to be super excited about this, and we discussed it yesterday, is Rick Rule is going to Rebel Capitalist Live. He's going to be there. You can meet him face to face. Going to be doing a presentation. He's going to be talking to you about commodities like gold, uranium, silver. In fact, a quick story, when I was in New Orleans about a month ago or so, speaking at the New Orleans Investment Conference, I had dinner with my good buddy Rick Rule, and I told him about the gold mine that I went to today in the middle of Colombia. It's in a place called Marmato, this mountain where they've been mining gold for 400 years. Very, very cool. And this is the second time I've been there. And Rick said, oh, yeah, I've been to Marmato many, many times. I started going there 20 or 30 years ago. And I can assure you, Marmato was not a place you wanted to go 20 years ago. Today, it's great, fantastic. 20 years ago, not so much. But it was really cool to see that he had a ton of experience. And you guys who don't know Rick Rule, look, he is the OG of OGs, him and Doug Casey, when it comes to investing in these junior miners, in commodity stocks in general. I mean, that would apply to uranium, oil, silver, platinum. And so if you haven't got your tickets to Rebel Capitalist Live, you got to do so ASAP, because on my watch list, the number one thing that I want to buy on the cheap, if we do have a recession, commodity stocks. On that bombshell, guys, enjoy the rest of your afternoon. As always, make sure that you're standing up for freedom, liberty, free market capitalism, and make sure you are getting your tickets to Rebel Capitalist Live at rebelcapitalistlive.com. And we'll see you in Orlando, May 23rd through the 25th.